Welcome to the Real Estate Playbook Talk Show, the podcast designed to help you navigate your journey from renting to owning. Each week, you'll get clear, actionable advice to simplify home ownership and build your financial future. Today's episode tackles one of the biggest hurdles in home ownership: credit. If your credit score is stopping you from qualifying for a mortgage, you're not alone. The good news is that you have the power to fix it, and I'll show you exactly how to. By the end of this episode, you'll have a clear roadmap to boost your credit and confidently move towards mortgage approval. So let's dive in. Hi, and welcome back to the Real Estate Playbook Talk Show. I'm so excited for episode 3. This is so exciting, and I'm so happy that you are on this journey with me. So let's not waste any time. So why credit matters for home buyers? So your credit score is more than just a number. It's a key factor that lenders use to assess your reliability as a borrower. It directly impacts several critical aspects of home ownership. Lenders have a minimum credit score requirement. Generally, a score of below 620 can make it tough to qualify, while a score of 680 or above significantly boosts your chances. So your credit score determines your interest rate. A high credit score can help you secure the best possible rate, potentially saving you tens of thousands over the life of your mortgage. For example, a $400,000 mortgage over 25 years, even a 0.5% difference in interest can mean savings for around $50,000 in total interest payments. Improving your credit score by 50 points can help you achieve these lower rates. A better credit score can lead to approval for larger loan amounts, increasing your purchasing power in competitive markets. If your credit score is lower, your lender might require mortgage insurance at higher premiums, increasing your monthly payments significantly. Consider a client named Sarah. Initially, Sarah's credit score was around 610, limiting her mortgage options significantly. After improving her credit score to 680, through careful financial management, she qualified for better terms, securing a home that was previously out of her reach. So the bottom line, your credit score profoundly affects your home buying journey, impacting your eligibility, your affordability, and long-term financial health. To effectively repair your credit, you first need to understand what actions can damage it. Here are the most common pitfalls. So late payments. Missing even one payment can cause significant drop in your credit score. Payment history is the single largest factor, about 35%, impacting your credit score. A history of late payments signals risk to lenders, making mortgage approval challenging. So say John forgot to make 2 credit card payments in 1 year. His score dropped nearly 80 points, delaying his mortgage plans for several months. Setting up automatic payments could have prevented this. So if you have a high credit utilization, using too much of your available credit can severely impact your score. Ideally, keep your credit card balance below 30% of your available credit. Maxing out your cards or consistently maintaining high balances signals financial stress to lenders. Jessica's credit score was stuck around 640. After paying down her balances and maintaining lower utilization, her score jumped to over 700 within 6 months. unpaid debts that are sent to collections or written off by lenders can drastically hurt your score. These negative marks can remain on your credit report for up to 7 years. Frequently applying for credit can indicate financial desperation and negatively affect your score. Each application results in a hard inquiry, slightly lowering your score. Emma applied for 3 different credit cards and a personal loan within 1 month. These inquiries caused her credit score to drop nearly 40 points, temporarily, but making her seem riskier to lenders. So avoid these mistakes by automating bill payments, monitoring your credit utilization, and addressing and negotiating debts promptly. Limit new credit applications, especially before applying for a mortgage. So improving your credit might seem daunting, but breaking it down into clear, manageable steps can make it achievable. Here's your step-by-step roadmap. So you want to check your credit report. So accessing your free annual credit report from Equifax and TransUnion. Review them carefully for errors such as incorrect personal information, accounts you didn't open, or incorrectly reported balances. So consider this. So Mike discovered 2 accounts incorrectly marked as delinquent on his report. After disputing these errors with supporting documents, he quickly boosted his score by 40 points. So set a calendar reminder to regularly check your credit reports at least every 6 months. So you go into Equifax and TransUnion websites, request your free annual credit report, highlight any errors clearly. How to dispute these errors? You want to submit disputes online through Equifax and TransUnion websites. Provide clear documentation supporting your claim, like payment receipts or identity proof. Another thing that you want to always look into is your payment habits. Always pay your bills on time. So late payments have the biggest negative impact on your score. So set up automatic payments or reminders to ensure timely payments. So Ashley struggled to remember payment dates, causing frequent late payments. She set up automatic payments for all of her bills and saw her credit score rise by 60 points over 6 months. So when you automate payments using online banking, you're actually making it a lot easier on yourself so you don't forget. And set payment reminders on your calendar or your phone. Regularly review your budget and ensure bills can be covered. So you want to reduce your credit utilization ratio. Aim to keep your credit card balances under 30% of your credit limit. Focus on paying down high interest debts first. For example, Rachel had 3 credit cards at or near her limit. She prioritized paying down the highest interest card first, gradually lowering her overall credit utilization and increasing her score by nearly 70 points. Here's a step-by-step process that you can look at. List all of your credit cards by balance and interest rate. Start by paying down the card with the highest interest rate. Pay more than the minimum payment when possible, and avoid new unnecessary purchases on these accounts. One of the other things that you want to look into is negotiating or settle debts that are in collections. So you want to contact collections agencies directly to negotiate settlements or manageable payment plans. Request the removal of the collection from your credit report upon full payment or settlement. David had an old cell phone bill. By negotiating directly with collections agencies, he paid and reduced the amount and had the negative item removed from his report, raising his score by 40 points. So you want to contact the collection agency in writing. Offer to pay the lump sum settlement for a reduced amount. Obtain confirmation that the debt will be marked as paid and ideally removed from your credit report. You want to limit new credit applications. Avoid opening new credit accounts unnecessarily, especially when preparing for a mortgage application. Each new credit inquiry can slightly lower your score temporarily. Your best practice would be only apply for credit when necessary and keep credit applications spaced apart, ideally several months. Some tools and resources to accelerate credit repair. Repairing your credit doesn't have to feel overwhelming. Using the right tools and resources can speed up the process, simplify your efforts, and keep you organized. Let's dive deeper into the best tools and resources available to accelerate your credit repair journey. Some credit monitoring tools. These tools provide ongoing access to your credit score, credit report, updates, and real-time alerts in any suspicious activity or major changes. Some recommended tools would be, say, Borrell. It's Canadian specific. Free access to your Equifax credit report and monthly credit updates. Personalized recommendations to improve your score. Sign up, then schedule monthly check-ins, monitor your progress closely, adjust your strategies based on the recommendations. Credit Karma is also another Canadian specific tool. It gives you free access to TransUnion credit reports and scores, regular notifications on significant credit changes, clear explanations of your credit profile. You want to compare your Equifax, which is Borrell, and your TransUnion, which is Credit Karma, reports regularly to note any sort of discrepancies. So for an example, Jessica used the Borrell to spot and dispute an incorrectly reported late payment. Regular monitoring helped her immediately address the issue, raising her score by 35 points. There's also some budgeting apps and tools that you can use to manage your money wisely, directly impacting your ability to pay down debt and save money and improve your credit. Some recommended tools would be mint.com. So it links your account securely and tracks spending automatically, allows creation of custom budgets, and it sends out alerts when you're nearing your budget limits. After connecting your accounts, categorize your expenses clearly, identify spending leaks, and direct any extra savings towards paying off high interest debts first. Set aside specific monthly amounts to pay off your debts systematically. Over time, this disciplined approach reduces your credit utilization and debt load. So Kevin used Mint to find he spent $200 monthly on unnecessary subscriptions. He canceled these and put the money that he saved directly towards his debt, improving his credit utilization rate and raising his credit score significantly within 6 months. Knowing exactly how long it will take to become debt-free keeps you motivated. These calculators show you exactly how much you need to pay monthly and how quickly you'll eliminate the debts. Recommended tools would be Vertex 42 Debt Reduction Calculator. It's an Excel spreadsheet. It gives you visual breakdowns of your debts, and it helps you create a clear monthly repayment plan. List your debts in this calculator. Choose either the avalanche method, so that's the highest interest first, or the snowball method, which is small balances first, then stick closely to this plan until debts are eliminated. Another tool would be .it. It's an interactive online tool. It can be customized to your debt payoff strategies. Regular email reminders and motivational updates. Regularly check your progress on undebt.it and adjust your payoff strategies if your financial situation improves or changes. There's also professional credit counseling. Sometimes personalized support makes all the difference. If you're struggling with complex credit issues or debt, professional counseling is invaluable. Some recommended resources: Credit Counseling Canada. It offers personalized advice, debt consolidation options, and financial education workshops. Most initial consultations are free or low cost. If overwhelmed, schedule an initial consultation. Be open about your financial situation and goals. They'll help you build a clear, achievable action plan. Ben felt completely stuck and contacted a credit counselor who created a structured debt repayment plan, negotiated lower interest rates with creditors, and provided ongoing support. This helped Ben gain control, become debt-free faster, and qualify for his first mortgage within 18 months. There's also educational resources and books. So depending on your financial literacy, there's also educational resources and books. So deepening your financial literacy. In summary, here's an action plan. Pick at least one credit monitoring tool to regularly track your credit score. Use budgeting tools to identify unnecessary spending and redirect those savings to paying down debts. You want to take advantage of debt calculators to set up a clear, actionable repayment plan, and consider professional credit counseling if you're overwhelmed or unsure. Invest in your knowledge regularly. Engage with financial education resources and stay motivated and informed. In closing, remember, repairing your credit doesn't happen overnight, but with consistent use of these tools and resources, you'll achieve faster, clearer, and more measurable progress towards mortgage approval. There's a lot of misinformation around credit repair. Believing these myths can slow down your progress or, worse, damaging your credit further. Let's tackle these myths directly and clear the confusion with real examples. Myth number 1, checking your credit score lowers it. The truth is, checking your own credit is called soft inquiry, and it does not affect your score. Only hard inquiries trigger when you apply for new credit, slightly lowering your credit score. Regularly reviewing your credit report through reputable services like Equifax, TransUnion, or Credit Karma, and you will not have to worry. Myth number 2, closing a credit card account improves your score. The truth? Closing accounts actually can lower your score. It decreases your available credit and raises your credit utilization ratio, harming your credit score instead of improving it. So for an example, Matt closed his oldest credit card to Simply Finances. His credit utilization immediately dropped from 20% to over 50%, dropping his score by nearly 50 points. So a better approach would be keep the oldest accounts open and active, even if you rarely use them. If you must close an account, ensure other balances are low to minimize negative impact. Myth number 3, paying off collections instantly removes them from your report. The truth is, paying a collection account marks it as paid, but doesn't automatically remove it from your report unless you specifically negotiated that. So Emily quickly paid off a collection debt, expecting it would disappear from her credit report. Months later, it was still negatively impacting her score. So some steps to resolve this would be, before paying, you want to negotiate a pay for delete agreement in writing. Pay the agreed upon amount and follow up to ensure removal. Regularly monitor your report until the negative entry is removed. So myth number 4, hiring a credit repair company guarantees results. No, the company cannot guarantee a certain outcome or magically fix your credit overnight. You can do everything a credit repair agency does yourself, often for free. For example, James paid a $1,500 debt to a company promising quick credit repair. Months later, his score barely changed, and the company disappeared, leaving him frustrated. So a smarter approach would have been to educate yourself on credit repair. You're already doing this by listening to this podcast. If choosing professional help, make sure you carefully research the company. Look for clear pricing, no guarantees, and positive reviews from real users. So myth number 5, bankruptcy means you can rebuild your credit. The truth, while bankruptcy can significantly impact your score, you can rebuild your credit effectively afterwards with disciplined steps. So Laura declared bankruptcy in 2018. Initially feeling defeated, she took simple, consistent actions. Opening a secured credit card, making small purchases, and paying them off monthly. Within 2 years, her credit improved enough to qualify for a mortgage again. Step-by-step recovery after bankruptcy. You want to start small with a secure credit card, pay every bill on time, no exceptions, and gradually introduce additional credit, carefully managed, as your score improves. Some key takeaways. Credit repair myths can waste your time, energy, and money. Understanding what's real empowers you and takes informed action. Practical tips to avoid these myths. Always verify information from reliable sources such as major credit bureaus, so like Equifax, TransUnion, or certified financial experts. Remain skeptical of promises that seem too good to be true. Reach out for professional guidance or second opinions from trusted advisors if unsure. Okay, so improving your credit score is a crucial step towards mortgage approval. Follow the practical strategies discussed today, and you'll be well on your way to owning your home sooner than you think. Do you need personalized guidance? You can DM me on Instagram at RELifeWithRochelle or book a free consultation. If you've enjoyed today's episode, please subscribe and leave a review. Your feedback helps more people achieve dreams of homeownership. On our next episode, we are going to talk about first-time homebuyer programs in Ontario. Everything you need to know. So we will see you next week, and I want to thank you for stopping by.